budgeting in projects. Capital budgeting, we want to know whether this project is going to maximize the welfare of shareholders. This project is going to bring about returns. This project is going to give us a sense that whether whatever we are doing, it makes sense within the context of the project. When we use capital budgeting techniques, it is important, you as a manager, you need to know the procedure on how do you go about it. Not only knowing the procedure, because you can allow somebody to compute for you, but again, you need to know whether those information that have been included in the capital budgeting, it makes sense from project management point of view. Because you are the finance people, so you'll find this session is just repetitive of what you have been doing in your other class. Before I talk much about capital budgeting, let me also review to you. We have been discussing about cost estimation. We have been discussing about revenue estimation. We have been discussing about the cash flow. We have been discussing about the budget and thereby looking at the key budget line items. We have been talking about that. Just to emphasize before I go to capital budgeting is you have there's someone, I think, let me someone is making a noise, eh? Someone is making noise. Yes, that is okay. A bit, it is okay. I have muted all of you. Okay, so what I was saying is, if you want to develop a very good executive summary in your project, write-ups or the project plan documents, the project charter, of which the project charter, you are going to be a manager managing a project, you must have a project charter, and that is one I have given you the assignment you will be dealing with. It is summarized in the context of 4 projects. Now, what does it mean here? You need also to develop forecasted income statement and also forecasted balance sheet. When you develop forecasted income statement, you will know, you will use the normal principles. The normal principles, just like the way we have already said. What you will have, you have your revenue, opening stocks, closing stocks, and so on. Project it by yourself. There is no single formula we can put here and say, how do you project 5 years or 20 years? No, it's up to you. You project based on the sales that is going to be expected. You project based on the assumptions that you will have by yourself. Now, the aim for us is to state the figure for annual profitability and accumulated profit. Those two figures are very important in project proposal documents, especially when you are writing the executive summary. When you are writing the executive summary, you need to demonstrate how much is the profit expected to be generated in annual, in year 1, year 2, and how much is the accumulated profit. So you include it in the executive summary, and therefore significant. And that's why for you to know the pro forma income statement is important. You will need to tell us profit before tax and profit after tax. So why is it is that elements will show how much the project is going to contribute towards taxes to the government. So it is important you know your executive summary or the abstract is the foundation to attract financial institution. They may not read the whole document, but just by reading the executive summary, they will know what are the key returns. So among the key returns are those ones. So you will have to develop those ones. And for the assets, no any project is expected to run without having assets or liabilities. You can use owner's equity, you can use whatever, but you need to brainstorm, even if it is a poultry project. You are doing poultry project, remember, you need to brainstorm your assets. What are the assets I will need at year 0, at year 1, at year 2, year 3, year 4, and so on. So whatever the assumptions around, we will need to understand if it is 5 years or 10 years, how much is the total assets going to be realized during the period. And remember, the whole project is characterized with the estimates. The proposal you are writing is based on the estimates, and those estimates must be very realistic. But again, it takes a balance for someone to control. So refer my lecture to read more about financial statement projections. It is there in the Moodle. You can read, you can listen to. So make sure you listen through the Moodle. You listen to those lectures. You will see on how things work in a brief. Now, because you have already determined your cost, you now know revenue, you now know the cash flow, you now know the income statement, you now know all your assets to which it provided the environments and the setting of your projects. But remember, I said here, we are not an accountant, but we need to apply this information. Any project must have those kind of features, even if it is constructions. For constructions, you will have your assets, you will have your liabilities and so on. So the building itself is your assets, okay? Vehicles are your assets. You, at one particular time, you will buy your vehicles, or sometimes you can sell your vehicles. So you need to estimate those times. As I'm saying is, most projects, they are based on the assumptions. They may be true happening of the events, or they may not be true happening of the events. And therefore, because we know the cash flow, we know the cash, the next phase for you as a manager, because you'll be controlling. Now, when you walk, you'll be walking within the plans. So you will use the project charter to which you have entered into contract with the financial institutions or the donor for that case to run the projects, which agreements you have. Now, for you, again, you need, before you commit a large amount of money, you must go to the so-called capital budgeting. Capital budgeting is the tool that is being used to assess the investments, to assess the projects, especially to those projects that are profit-oriented. If you are a manager running a profit-oriented, or maybe you have been requested to plan the so-called a profit motive or commercial project, then you must appraise. You must appraise. You use the tool to accept or to reject. Now, when you say which tools you will use, of course, your consideration will be figuring out, you considering one of the measurement. That is, you can either opt to use the internal rate of return, or you can use the net present value, or you can use the payback period, or you can use the profitability index, or you can use the accounting rate of return. You select one of those, but which one is the most common one? The most common one among all those we are talking about is the application of the net present value. It is the most preferable one. So 75% of the firms uses the so-called net present value as a tool to measure or to make a decision whether to accept or not to accept. So you will see yourself that this is the net present value. So because many companies are using it. Other companies are using the internal rate of returns, and others are using the payback period. But very few companies uses payback period. Only 20% of companies use internal rate of return. So you can imagine which one is the most preferable one. It is the net present value. So you select one in your proposal, you use that one to explain. You don't need to use all of them. You'll be confusing the decision. You as a manager, you cannot come up with the correct decision when deciding which one you should use to make your decision. So whatever the case, you select one. You select one. And I also say for that case, refer the lecture sent to you in your Moodle. You can read that one. Then tomorrow we can do some practice, practical example. We shall be doing it by tomorrow. So I would like you to make a quick summary before we discuss it in detail tomorrow. Tomorrow we shall be doing practical example. So I have given you, you'll go through the Moodle and examine and see the lecture by yourself and make your own summary, prepare for tomorrow. Tomorrow we shall do some practical examples that everybody would understand what do we mean in here. So that is one of the issues. But before, I'm just summing up the lecture, I have sent it to you. But there is one thing that we need to know. What is that? You have other consideration. When I say about other consideration, is you as a manager, you need to go beyond those variables we have said for maybe you are using internal rate of return and all that. You are only explaining one aspect, that is financial aspect. So as we said, some of you will be writing or maybe managing a non-profit project making, and others will be managing profit making. So you will be required to make other consideration like social appraisal or social consideration, institutional appraisal, economic appraisal, environmental appraisal, what is technical appraisal, gender appraisal, and so on. So these are the common ones for manager to have a focus because they are risky in the projects. You cannot just come up with a project and you start running without looking at the community, whether how people view your projects. It will be disaster to you if you miscalculate the society. You're trying to launch your project without assessing the perception of the society. You are going to be the wrong person. Don't underestimate. Apart from computation, but you also need to look at the social point of view. How do they view these projects? What are the key desirable elements that will help? What will be the impact to the society of your project? So you explain that context to support